When Credit Suisse collapsed into UBS in March 2023, the Swiss franc surged against the dollar. Most traders expected the opposite. A banking crisis in your own country should weaken your currency, not strengthen it. That's what happened to the pound during the 2008 crisis. That's what happened to the euro during the sovereign debt crisis. So why did the franc rally when Switzerland's second largest bank imploded? The answer lies in something most people completely overlook when they watch currency markets react to financial stress. The direction of liquidity flows matters far more than the headlines. And if you don't understand how liquidity moves during moments of banking strain, you'll misread almost every major currency move tied to financial stability events. This isn't about predicting where currencies are headed. It's about understanding the mechanics that institutional desks watch in real time, mechanics that retail commentary almost always gets backward. Before we go further, I want you to think about one thing as you watch this. Every time you see a currency move that doesn't match the headlines, ask yourself, where is the liquidity actually going? That question will save you from misreading the next banking shock, the next central bank intervention, or the next credit event that moves FX markets in ways that seem counterintuitive. Keep that frame in mind, because everything we're about to unpack hinges on it. Most people see a bank failure and assume the home currency weakens. It makes intuitive sense. A bank collapses, confidence in the financial system drops, capital flees, and the currency falls. That's the pattern most traders and commentators expect, and it's the pattern that plays out in some cases. But when Credit Suisse was absorbed into UBS over a single weekend, the franc didn't collapse. It strengthened. The same thing happened in different forms during the regional banking stress in the United States in early 2023. When Silicon Valley Bank and Signature Bank failed, the dollar didn't uniformly weaken. In fact, against certain currencies, it held firm or even gained ground. The headline logic suggested dollar weakness. The liquidity logic told a completely different story. Here's what most people miss. They treat all banking crises as the same. They assume that stress in the banking sector automatically means capital flight, currency weakness, and risk-off behavior that punishes the affected currency. But that framework ignores the single most important variable, where the liquidity shortage actually is. If the banking stress creates a scramble for a specific currency to meet funding obligations, redemptions, or margin calls, that currency doesn't weaken. It strengthens. That's not a theory, that's mechanical. When institutions need to buy a currency to cover liabilities, they bid it higher. It doesn't matter what the headlines say about confidence or stability. The price moves because of the flows, not the narrative. Let's take the Swiss franc example and break it down properly. Credit Suisse wasn't just a Swiss problem. It was a global institution with liabilities denominated in multiple currencies, counterparty exposures across continents, and derivative books that tied into every major financial center. When the bank's viability came into question, the immediate institutional response wasn't to sell francs, it was to cover franc-denominated exposures. Hedge funds, asset managers, and other banks that had borrowed in francs or held short franc positions suddenly faced a scenario where those positions might become difficult to manage. The knee-jerk reaction wasn't to flee Switzerland. It was to buy francs to reduce exposure, close out positions, and ensure they weren't caught on the wrong side of a liquidity squeeze. That buying pressure, concentrated and urgent, pushed the franc higher even as the headlines screamed crisis. Now contrast that with what happened during the European sovereign debt crisis a decade earlier. When Greek banks were failing and the Eurozone stability was in question, the euro weakened significantly. Why? Because in that case the liquidity dynamic ran in the opposite direction. Investors weren't scrambling to buy euros to cover liabilities. They were selling euros to exit exposures. The flow direction was reversed. Capital was leaving the Eurozone, not rushing in to meet obligations. The headline in both cases might say banking crisis, but the liquidity mechanics were fundamentally different. And if you only read the headlines, you'd expect the same currency reaction in both situations. You'd be wrong both times. This is the part where I want you to pause and consider your own understanding of these events. When you see a banking headline and a currency move, do you instinctively check where the liquidity imbalance is, or do you assume the currency will weaken because the news sounds bad? There's no judgment here, but recognizing that gap in your own thinking is the first step to reading these situations correctly. And once you see it, you'll start noticing how often market commentary gets this backward. The same principle applies to central bank interventions, but in a slightly different form. When the Federal Reserve opened dollar swap lines during the 2020 liquidity crisis, the dollar initially surged. That confused a lot of people. The Fed was flooding the world with dollars, so shouldn't the dollar have weakened? In theory, yes. More supply of something should lower its price. But that's not how liquidity crises work in real time. Before the swap lines were opened, there was a desperate scramble for dollars. Foreign banks, corporations, and governments needed dollars to meet obligations, and they were bidding aggressively for them. That buying pressure sent the dollar sharply higher. The swap lines eventually eased that pressure, but the initial move was a liquidity-driven spike, not a confidence-driven rally. The dollar strengthened because people needed it, not because they believed in the U.S. economy. Here's where the institutional logic becomes critical. Banks and asset managers don't operate on sentiment. They operate on cash flow, collateral requirements, and liability matching. When a liquidity event hits, the first question isn't, what do I think will happen? It's, what do I need to cover right now? If a bank has borrowed in yen to fund dollar assets, and suddenly those dollar assets are losing value or becoming illiquid, the bank doesn't sit around debating the outlook for the Japanese economy. It buys yen to cover the liability. That's mechanical. That's not a vote of confidence in Japan. It's a balance sheet operation, and when enough institutions are doing the same thing at the same time, the currency moves. The narrative might catch up later, but the price moves on the flows first. Think of it this way. Imagine a corporate bond that's widely held by international investors, but the bond is denominated in Australian dollars. Most of those investors are based in Europe or the US. They don't particularly care about Australia. They bought the bond for yield, not for a view on the Australian economy. Now imagine that bond's issuer runs into trouble, and investors start dumping the bond. To sell that bond, they also have to sell Australian dollars, because the proceeds are in Aussie dollars and they want to convert them back to euros or dollars. That creates selling pressure on the Aussie dollar. Even though the underlying problem has nothing to do with Australia's economy, its central bank, or its fiscal position. The currency moves because of the liquidity mechanics tied to that specific bond, not because of any fundamental view on Australia. That's a simplified example, but it's exactly the kind of dynamic that plays out on a much larger scale when banks or large institutions face liquidity stress. Now let's flip that scenario. Imagine instead that the bond issuer is forced to redeem the bonds early, and investors holding those bonds suddenly receive a large Australian dollar payout. If those investors are based outside Australia and don't want to hold Aussie dollars, they'll sell them immediately. That creates Aussie dollar selling pressure. But if the redemption was triggered by a liquidity event that also created a separate need for Aussie dollars elsewhere in the financial system, those two forces might offset each other, or one might dominate, depending on the size and urgency of the flows. The point is, you can't predict the currency move just by reading the headline about the bond issuer. You have to know where the liquidity is going and who needs what currency when. This is why banking stress doesn't always lead to home currency weakness, and why liquidity injections don't always lead to currency weakness either. The direction and intensity of the liquidity shift determines the currency move, not the sentiment around the event. And this is where most retail traders and even some professional commentators go wrong. They anchor on the headline, assume a certain type of currency response, and then get confused when the market does the opposite. The market isn't being irrational. The commentators are watching the wrong variable. Have you ever noticed how certain currency pairs seem to ignore major news events while others react violently to the same type of headline? Drop a comment with a keyword like liquidity mismatch if you've seen this happen and couldn't explain it at the time. And while you're thinking about that, tell me this. Do you agree that most FX analysis focuses too much on sentiment and not enough on actual flows? Yes or no? I'm curious where you stand on this because it shapes how you interpret everything that follows. Let's go deeper into the institutional side of this. When a bank faces a liquidity crunch, it has a few options. It can sell assets, borrow from other institutions, borrow from the central bank, or recall loans. Each of those options has a different impact on currency markets, and the impact depends entirely on which currencies are involved. If the bank sells U.S. Treasury bonds to raise cash, that might put downward pressure on bond prices, but it doesn't directly move the dollar unless the bank is converting those dollar proceeds into another currency. If the bank borrows from the Federal Reserve's discount window, that creates dollars. But those dollars stay within the U.S. banking system unless they're used to meet foreign currency obligations. On the other hand, if the bank has borrowed euros to fund yen assets, and it suddenly needs to unwind that position, it will sell yen and buy euros. That creates direct currency market pressure. And the move happens fast because it's not discretionary. It's a forced transaction. This is the part that separates institutional FX analysis from retail FX analysis. Retail traders often look at fundamentals like interest rates, GDP growth, and inflation. Those things matter over the medium to long term, but they don't explain sudden sharp currency moves tied to liquidity events. Institutional analysts, by contrast, are tracking funding flows, collateral chains, and cross-border liability structures. They know which banks have large foreign currency exposures, which asset managers are running leveraged carry trades, and which central banks are likely to intervene if liquidity stress escalates. That information isn't secret, but it's also not sitting in a headline. You have to dig into flow data, bank balance sheets, and central bank reporting to piece it together. And when a liquidity event hits, that's the information that tells you which currency will strengthen and which will weaken. Here's a concrete example. During the European banking stress of 2023, several European banks faced funding pressure. At the same time, the European Central Bank was tightening policy and reducing its balance sheet. That combination created a liquidity squeeze in euros. European banks needed euros to meet regulatory requirements and manage their balance sheets. At the same time, some of those banks had dollar liabilities or dollar-denominated assets funded with euro borrowing. When liquidity tightened, they couldn't easily roll over those euro funding sources, so they had to either shrink their dollar asset positions or find alternative euro funding. In either case, the immediate pressure was to acquire euros, not to sell them. That meant euro buying pressure at a time when the headlines were focused on European banking stress. If you only read the headlines, you'd expect euro weakness. If you track the liquidity flows, you'd expect euro strength, at least in the short term. And that's exactly what happened in certain episodes during that period. The same logic applies to carry trades, which are a massive driver of currency flows. A carry trade involves borrowing in a low interest rate currency and investing in a higher interest rate currency. For years, the Japanese yen has been the quintessential funding currency for carry trades. Investors borrow yen at near zero rates, convert to dollars or another higher yielding currency, and invest in assets that pay more. That works beautifully as long as the yen stays weak or stable. But when liquidity stress hits and investors need to unwind those positions, they have to buy yen to repay the original borrowing. That creates sudden yen strength, even though nothing fundamental has changed about Japan's economy. The yen rallies because of forced buying, not because of improved economic conditions. And if you don't understand that carry unwinds are a mechanical source of liquidity-driven currency moves, you'll be completely blindsided every time it happens. Let me give you an analogy that might make this clearer. Imagine a small town with one gas station. Normally, people fill up their tanks gradually throughout the week. The gas station owner orders fuel based on that steady demand. Now imagine a hurricane is coming, and everyone in town rushes to the gas station at the same time to fill up before the storm hits. Suddenly, the demand for gas spikes. The price might go up, not because the cost of oil changed, but because of the sudden surge in local demand. The gas station might even run out of fuel temporarily. That's a liquidity squeeze. The underlying supply of oil in the world hasn't changed, but the local liquidity, the immediate availability of gas at that station, has been overwhelmed by a sudden shift in demand. Currency markets work the same way during liquidity events. The overall supply of dollars, or euros, or yen in the global system might not change much, but if there's a sudden need for one of those currencies in a specific part of the financial system, the price moves sharply because of that localized liquidity imbalance. Now here's the part that makes this framework so valuable. Once you understand that liquidity shifts drive short-term currency volatility more than sentiment or fundamentals, you stop being surprised by counterintuitive moves. You stop thinking that banking stress always means home currency weakness. You stop assuming that central bank easing always means currency weakness. Instead, you start asking, where is the liquidity shortage? Who needs to buy what currency right now? and which institutions are most likely to be forced into those transactions? Those questions cut through the noise and get you to the actual driver of the price move. If you found that analogy helpful, do me a favor, don't just keep this to yourself. Share this video with someone who's trying to understand how currency markets actually work, not just how they're supposed to work in theory. The education system doesn't teach this. Most finance courses barely touch on liquidity mechanics. So if you know someone who's genuinely trying to learn how institutional markets operate, send this their way. No need to comment or like, just share it where it adds value. Let's talk about what would actually change the dynamic we've been discussing. Understanding liquidity-driven volatility is one thing. Recognizing when that dynamic is about to shift is another. The key variable to watch is the availability of liquidity itself. As long as central banks are willing and able to provide emergency liquidity to banks facing funding stress, liquidity-driven currency spikes tend to be short-lived. The central bank steps in, provides the needed currency through swap lines or discount window lending, and the acute shortage eases. The currency move reverses or stabilizes. But if a central bank is unable or unwilling to provide that liquidity, the shortage persists, and the currency move extends. That's when short-term liquidity pressure turns into a sustained currency trend. We saw this during the European sovereign debt crisis. The ECB initially hesitated to provide unlimited liquidity support to peripheral Eurozone banks. That hesitation allowed the liquidity shortage to persist, and the euro remained under pressure for an extended period. It wasn't until Mario Draghi's whatever it takes speech and the introduction of outright monetary transactions that the liquidity dynamic shifted. Once the market believed the ECB would provide unlimited euro liquidity to prevent a banking collapse, the acute euro selling pressure eased. The currency stabilized not because Europe's fiscal problems were solved, but because the liquidity backstop was credible. The same principle applies to cross-border liquidity. The Federal Reserve's willingness to extend dollar swap lines to foreign central banks is a critical factor in preventing prolonged dollar liquidity squeezes. During the 2020 crisis, the Fed acted quickly to open and expand those swap lines. That decision short-circuited what could have been a much more severe and prolonged dollar shortage. Foreign banks that needed dollars to meet obligations could access them through their own central banks, which borrowed from the Fed. That reduced the need for those banks to bid aggressively for dollars in the open market, which in turn capped the dollar's rally. If the Fed had refused to open those swap lines, the dollar would have spiked much higher and stayed elevated much longer, because the liquidity imbalance would have persisted. So what should you be watching if you want to anticipate whether a liquidity-driven currency move will be temporary or sustained? First, watch central bank communication around liquidity provision. If a central bank signals it's ready to act as a lender of last resort and provide unlimited liquidity in its own currency, that's a sign the acute shortage will be short-lived. If the central bank hesitates, sets conditions, or signals limited capacity, the shortage may persist. Second, watch cross-border swap line activity. If the Fed or ECB or another major central bank activates or expands swap lines, that's a direct signal that liquidity is being provided to ease foreign currency shortages. Third, watch bank funding spreads. If the cost of borrowing a currency in the interbank market or through commercial paper spikes and stays elevated, that's a sign the liquidity shortage is real and not being adequately addressed. If those spreads narrow quickly after spiking, it means liquidity is flowing back into the system. Another variable worth watching is the behavior of leveraged accounts. Hedge funds, CTAs, and other leveraged players often amplify liquidity-driven moves because they're forced to unwind positions when volatility spikes or margin requirements increase. If you see a sharp currency move accompanied by reports of margin calls or forced liquidations, that's a sign the move is being driven by liquidity mechanics, not by a fundamental reassessment of the currency's value. Those moves tend to reverse once the forced selling or buying is complete, assuming the underlying liquidity shortage is addressed. Here's the thing, though. You can't front-run these moves with precision. The liquidity shortage often appears suddenly, and by the time it's visible in market prices, the initial spike has already happened. But you can avoid being on the wrong side of the move by understanding the mechanics. If you're positioned based on a fundamental view that a currency should weaken because of bad news, but you're not accounting for potential liquidity-driven strength, you'll get stopped out before your fundamental view has a chance to play out. Conversely, If you're chasing a liquidity-driven currency spike without recognizing that it's temporary, you'll be holding the position when it reverses. The framework isn't about predicting the exact move. It's about understanding why the move is happening so you can assess how durable it's likely to be. Let me ask you this, and I want you to actually think about your answer. What recent currency move caught you off guard? And in hindsight, could it have been explained by a liquidity shift rather than a fundamental change? Drop a comment with a keyword like swap line dynamics or funding stress divergence if you've seen this play out in real time. And here's a bigger question. What topic should I cover next? Should I go into how central bank balance sheet changes affect currency volatility, or should I break down how cross-border capital flows create hidden liquidity imbalances? Let me know what you'd find most useful, because the goal here is to build your understanding step by step, not just throw information at you. Now let's pull all of this together and reframe what the title of this video is really about. When we talk about what most people miss about liquidity shifts driving currency volatility, we're not talking about some obscure technical detail. We're talking about the core mechanism that causes currencies to move sharply during financial stress, and the reason those moves so often contradict the headlines. Most people see a banking crisis and expect the home currency to weaken. Most people see a central bank inject liquidity and expect the currency to weaken. Most people see a risk-off event and expect safe haven currencies to strengthen across the board. But none of those assumptions hold up when you account for where the liquidity is actually flowing. The lesson here is broader than just understanding one or two specific currency moves. The lesson is that liquidity flow direction matters more than sentiment, more than headlines, and often more than fundamentals in the short term. If institutions need to buy a currency to meet obligations, that currency will strengthen, even if the news is bad. If institutions need to sell a currency to exit positions, that currency will weaken, even if the fundamentals are improving. The flows determine the price, and the flows are driven by liquidity imbalances, not by narratives. This is the framework that institutional FX desks use every day. They're not trying to predict whether a currency will be higher or lower in 6 months based on interest rate differentials or GDP forecasts. They're tracking which banks have large foreign currency exposures, which asset managers are running leveraged trades, which central banks are providing or withdrawing liquidity, and which parts of the financial system are most vulnerable to sudden funding stress. That information tells them where the next liquidity-driven currency move is likely to come from, and whether it's likely to be temporary or sustained. For you as a viewer, the takeaway is this. The next time you see a currency move that doesn't match the headlines, don't assume the market is irrational or that something strange is happening. Assume there's a liquidity dynamic you're not seeing. Ask where the liquidity is flowing. Ask which institutions are being forced to transact. Ask whether the central bank is providing backstop liquidity or allowing the shortage to persist. Those questions will give you far more insight than any headline-based analysis ever could. And here's the bigger picture. Once you internalize this framework, you stop being reactive to news and start being analytical about flows. You stop assuming that bad news means currency weakness or that good news means currency strength. You start recognizing that currency markets are driven by institutional cash flows, collateral needs, and liability management, especially during periods of financial stress. That shift in perspective doesn't just help you understand individual currency moves. It changes how you interpret every major macro headline tied to banking, central banks, or financial stability. If you made it this far, I appreciate you sticking with me through a detailed breakdown. If you found this valuable, hit the like button so the algorithm knows this kind of content is worth showing to more people. And if there's a specific macro or FX topic you want me to break down next, drop it in the comments. I read them and I use them to shape future videos. Finally, if you're serious about understanding how institutional markets actually work, not just how they're supposed to work in theory, subscribe. I don't do hype. I don't do predictions. I do clarity on mechanics, and that's what you'll get every time. Thanks for watching, and I'll see you in the next one.